Masraf Al Khaliji Commercial Bank merger, Dukhan IBQ merger, again, Beyond Qatar NCB and Samba merger. If you look at the big picture, general overview of Qatar, valuation and opportunities, cost income ratio and net staple funding ratios, stage 1 and stage 2 financing ratios, and there is a second wave of mergers in the Gulf. Let's talk about general view. Qatar's banking system, of course it's overbanked, could see more consolidation triggered by pressure on banks' profitability from the coronavirus pandemic, particularly those with a weaker franchise and limited pricing power. That's what Fitch is saying. Common government ownership is also a key driver for consolidation to create better capitalized banks with enhanced competitive advantage to support the Qatar's Vision 2030 development plan. Al Khaliji Commercial Bank, again, rating if you look at A and stable, and Islamic Bank Masraf Al Rayan, what you call MAR. A recently agreed merger will potentially create Qatar's largest Islamic bank by total assets and diversify the business model, which is predominantly wholesale focused. 85% of the total financing is wholesale focused. This will be the second merger in Qatar between Islamic Bank and a conventional bank after Islamic Bank Dukhan, an international bank of Qatar, merged in April 2019. It was called Barwa, now it's called Dukhan Bank. Let's look at the valuation and opportunities. Despite a weaker economic environment and expected downward pressure on the valuation from the impact of pandemic, Al Khaliji was valued at Qatar Riyal 8.2 billion based on closing share price on 5th January, representing 1.14 times its tangible book value, compared with 1.027 tangible book value of IBQ. This is pre-merger. This reflects Al Khaliji adequate capitalization, end of third quarter 20, common equity tier 1 ratio of 14.8% against 8.5% regulatory minimum, and private banking niche, an important addition to Masraf Al Rayan's business model and a funding franchise. MAR, the surviving entity, will have a larger funding capacity, 147 billion combined, to finance additional government projects. This could further increase MAR's exposure to government and government-related entities, which represent 47% of its financing, 47% of its financing book at the end of third quarter 2020. But would support the bank's asset quality. Nearly 50% of the books is for the government. The combined entity is said to be well capitalized with a leverage ratio about 12%, although one-off integration costs could weaken the capital. Cost income ratio and net stable funding ratio. The merger should strengthen Masraf Al Rayan's private banking funding franchise, which could reduce the bank's high reliance on wholesale bank funding, particularly short-term placements, and lower its loan-to-deposit ratio, which is one of the highest in the market. Masraf Al Rayan merger should result in a cost-income ratio about 20%, compared well with the peers. Dukhan Bank merger with IBQ boosted the proportion of retail and private banking deposits. 43% of the deposits end of first half of last year. It's overall funding. However, the banks still lacks a stable long-term funding and is yet to meet 100% net stable funding ratio regulatory requirements. The cost-income ratio decreased to 32% in the first half from 38% in 2018. After the bank realized 90% of its planned cost synergies from its mergers. So you can have revenue enhancement, cost synergies. So It's important. If you look at a stage 1 and stage 2 financing ratios, mergers can also increase banks' asset quality risk from collateral valuations, changes in loan classification, and building provisions against purchase credit impaired assets. Dukan's stage 2 financing ratio increased to 19% at the end of first half of 20 from 14% at the end of 2018, largely due to the reclassification of some of its IBQ loans that had been recorded at stage 1 at the time of the merger. Masraf Al stage 2 financing was only 3% covered by specific reserve at the end of third quarter 20, and its cost of risk was 0.3% in 9 months 20, the lowest in the sector, indicating the bank's financing book might be under provision, possibly. Who knows? Because if you look at 50% of the books, it's nothing but government, so you know they have value advantage. After the merger, Masraf Al find its reserves coverage insufficient if there is a significant financing migration from stage 1 to stage 2 after Qatar's credit moratorium expires in June 21. If you look at NCB and Samba Group mergers, that is Saudi Arabia. Saudi Arabia's biggest bank, National Commercial Bank and Samba Financial Group, announced that their shareholders have approved the merger to create a kingdom's largest lender. The merged entity will be called Saudi National Bank, and operations under the new name and structure are planned to start on April 1st, 2021, not far. So NCB and Samba Financial Group will become Saudi National Bank. Saudi National Bank will now be the biggest in the country with roughly 30% market share across all metrics. 30% market share, that's huge. When it comes to October last year, NCB, Saudi Arabia, largest lender by assets, confirmed that it would offer $15 billion to buy Samba Financial Group, paying Saudi Riyal 28.45 for each Samba share. The new bank is estimated to have total assets of more than $220 billion. $220 billion, creating the largest lender in the GCC region. $220 billion. In preparation for the proposed merger, NCB received approval from CMA, Capital Market Authority, to increase its capital from Saudi Riyal 30 billion to Saudi Riyal 44 billion. So, in order to issue new shares in NCB to Samba shareholders with a share price swap, if you look at share swap ratio of 0.739 NCB ordinary shares for each Samba ordinary share upon closing the transaction. So, interesting development. If you look at Samba shares, will be delisted from the Tadawul, that's the like Saudi exchange, on the effective date of the merger, and the company dissolved with all its assets, liabilities and operations transferring to Saudi National Bank. NCB's existing shareholders will own 67.4% and Samba shareholders will own 32.6% of the combined entity. The kingdom's sovereign wealth fund, the public investment fund, will be the largest shareholder in Saudi National Bank with a 37.2% holding. So you have a government holding. Kingdom's sovereign wealth fund, public investment fund, will be the largest shareholder in Saudi National Bank with 37.2% holding. The deal comes after NCB dropped plans to merge with Riyadh Bank to create a bank about 200 billion assets. So it was there, it's not there now. It's going to be now Samba. Second wave of mergers in GCC. The GCC banking sector is bracing for a second wave of mergers and acquisition after suffering a triple shock to profitability in 2020 from lower lending growth, lower interest rates and high cost of risk. The second M&A wave could begin when the full impact of the weaker operating environment on banks becomes visible. The second wave will be more opportunistic and spurred by economic rationale. The operating environment might push some banks to find as strong shareholders or join forces with peers to enhance resilience. Second wave will be more opportunistic and spurred by economic rationale. Second wave of mergers, the twin challenge of the pandemic and protracted low oil prices will hit the bank's profitability through slower credit growth, the slimmer net interest margins and high provisioning for bad loans. Revenue shock will shift management attention to cost discipline and consolidation opportunities. Mergers and acquisitions will remain a recurring credit, that's the story, a recurring credit theme over coming years. So definitely mergers and acquisitions are all there. The pandemic, oil prices, all needs to be looked at it. The revenues are coming down and attention to cost discipline. In Saudi, mortgage lending continues to expand due to the authorities' objective of increasing the home ownership, while Qatar government projects are boosting growth. Demand from corporate will likely to improve only slightly, with some of the difference 2020 capital expenditure and debt refinancing potentially occurring this year. So this is the big picture. A lot of action, plenty of action to come in terms of mergers acquisition in the coming days.